But I would say if you're considering getting into real estate and you haven't taken action, you want to be a real estate investor of some kind, whether it's passive or active. The worst thing you can do is nothing. The worst thing you can do is just sit around and wait for the perfect deal, read a bunch of books, listen to podcasts, and just not take action. And my advice is take a risk. Deploy your capital somewhere, buy a rental, buy a flip, invest with a sponsor that you get to know that you can kind of trust and understand their track record. Because wealth creation in real estate takes a lot of time. But the worst thing you can do in this real estate investing world is nothing. So take action and take a
Welcome to the Generations of Wealth podcast. I am your host, Derek Dombeck, and today we're taking a journey with a gentleman named Jacob who went from flipping houses to now hundreds of millions of dollars worth of self-storage and everywhere in between. We're focusing on investor relations, sourcing deals, everything you can imagine. Before I bring him on, though, I always like to take a moment to thank you for being here and listening to my show. And anything I can do to help you in any way, shape, or form, please don't hesitate to reach out. Go to derekdombeck.com, thegenerationsofwealth.com, or just simply shoot me an email, derek@globalgow.com, and let me help you. So, with that, let's bring on our guest. And as promised, here he is, Jacob Vanderslice. Jacob, thank you so much for being on Generations of Wealth show.
Derek, good to see you. I always like talking to Wisconsin boys.
Well, I appreciate that, and I know you live out in God's country in Colorado, where I have spent a lot of time and look forward to getting back to as well. So I don't know how people live in the big cities, East Coast, West Coast, but there's something for everybody, I guess.
Yeah, yeah, keep it our secret.
Yeah, absolutely. You don't want any more Californians coming and buying up Colorado real estate?
Yeah, yeah. Our slogan in Colorado should be "Stay away, we're full."
Yeah, yeah. So if you're listening to this from California, we love you. Just stay there. So, uh, well, Jacob, why don't you just give us a little background on who you are, first of all, and let's kind of start with what you started on doing, and you've got an incredible story from start to finish. So we'll start there.
Yeah, I'm a simple real estate hack. I've been a full-time real estate investor since 2006, and before that, I was in the fire service out of college, and I had some time on my hands. You only work 10 days a month, so I started dabbling in residential and doing rentals and fix and flips, and that was a heck of a time to get in the business on the precipice of a major downturn, and took a lot of lumps. I wouldn't trade it for anything. I learned a lot. I think about those days every day. And then kind of coming out of the financial crisis, we started buying a lot more residential deals at the auctions and distressed seller marketing. I did a bunch of those, mainly in Denver, but all over the country. Along the way, we did adaptive reuse retail projects. We did some townhome development, some multifamily, a little bit of office and industrial. And in 2015, we did our first self-storage project. And at the time, it wasn't really strategic pivot into a new asset class. It was more just like, oh, let's try something new out, see how it goes. We liked the fact that it was a little more scalable, repeatable, arguably more durable income streams. So we did one project, we did a second one, and over time we evolved into being pretty much exclusively self-storage owner operator. So today we own 41 facilities. Those comprise about 21,000 units, about 3.5 million square feet in 15 different states. Most of the deals we do are value add existing facilities where we see some level of operational inefficiency. Maybe their rents are below market, their expenses are above market, they may not advertise. So that's most of the deals we target. We'll occasionally do development projects. And when I say development, I mean buying vacant land and building a brand new building, in this case, self-storage. We only have two of those in our portfolio. We've done more than that over the years, but we sold some. So that hopefully gives you a flavor for who we are and what we're up to.
So you haven't done a whole lot, is what you're saying.
Yeah, it's when you look back at the years, it's been a lot of years, and I guess a fair amount of deals over those years. But I'll tell you, it's been difficult in all aspects, as I'm sure you and your listeners agree. The last couple of years, just capital flow has been challenging. Obviously, interest rates, inflated hard costs, inflated land costs, lack of certainty on, where the world's going. There's always uncertainty on the future, but I feel like that's especially pronounced the last 6 or 9 months or so. But we're still doing deals. Our portfolio is doing well, but it's a materially different environment than it was in the easy days of 2021.
Well, and I like talking to people, and my regular listeners know this, that have been in the business through multiple cycles. So I started in '03, and you said you took your lumps. I flat out got my ass kicked. And
Yeah, I would agree
same
with the
thing.
ass kicking. I don't want to diminish how difficult it was. Yeah,
It,
absolutely.
and I also agree with you. Like I think about those times every day, and it was a blessing. It led me to where I am today, what I do today, and the people I get to help because of what I went through. But you still got to make it through. And you know, with what you're doing now, and you said the uncertainty the last 6 to 9 months, what do you see coming specifically in your niche?
Well, I'll start my commentary from a bit of a more macro perspective, and then we'll go micro, and I'll try to make it succinct. But go back to 2022, and I'm in the habit of saving alarmist articles and screenshots, and then calendaring those links in some future date, and then kind of revisiting what happened and what didn't happen. And, in the summer of 22, the headlines were on the precipice of a recession, right? The rich are shedding assets, there's cracks in the job foundation. And here we are, right? 3 years later, and maybe we're on one, maybe we're not, and we'll get into that in a moment. But, if you would have told me where interest rates were going over the next 3 years, starting in early mid 2022, I would have guaranteed you that we would have seen a decline in single family home values, right? Values have to go down, interest rates go up. We all know what happened and went the opposite direction, right? And why did it do that? Well, I think transaction volume diminished because people had a lot of cheap rates locked up. They had a lot of equity. They don't want to move because they want to pay off their 3% mortgage to borrow at a 7 or whatever the rate might be. And I think as we sit here today, um, we're finally starting to see some maybe measurable cracks in the foundation. Um, I don't know if you recall the jobs report that came out last week. We're recording this in the first latter part of the first week of August. They revised down the job growth numbers by I think almost 260,000. That's a big number. And just anecdotally, you read articles about the Vegas hotel occupancies dropping materially. And in Colorado, I'm hearing reports about all of our tourist towns in the mountains. Short-term rental bookings are way down. Hotel occupancies are way down. Maybe all of these kind of subjective, objective data points between that, the revised job numbers, maybe we're going into a measurable macro level softening. We'll see. I thought we were going to have one in 23. Nope. I thought the same thing in 24. Wrong again. I always get a 50-50, right? I tend to pick the wrong one. But it feels like maybe finally the fundamentals are starting to break down a little bit. As it relates to our business, self-storage has not escaped the challenges of the real estate headwinds that we've all seen the last couple of years with rising interest rates, a lack of transaction volume. And I would say the biggest headwind that we've seen is diminished consumer demand. And why is that consumer demand diminished? Well, secondarily, you had a lot of new supply come online. People broke ground in fundamentals in 22 and 23. They delivered in 24 and 25 in a materially different environment. But I think primarily that suppressed consumer demand is coming from what I commented on a moment ago, which is a reduction in single family home transaction volume. People are just less mobile than they used to be. They're not moving up and down the economic ladder at the frequency they were in prior years. And our industry benefits from mobility and movement. And I think if we have a softening, measurable softening in whatever form that might take, we might start to see movement kick back up again. Maybe interest rates drop and home values drop. People who were priced out of the market for a while get back into the market and start transacting more. Maybe someone loses their job and they can't afford to service their debt anymore, so they sell their house. So I'm not wishing a downturn on the country by any means, but it's been too good for too long. And I think a moderate cleanse would be healthy. And that certainly could benefit all real estate industries potentially, specifically storage, just because of that consumer demand. And as people start moving more, they inherently might need more storage units. So we'll see what happens. Maybe this is a blip from last week, and maybe it's the beginning of a longer trend. Time will tell.
You're much softer about it than I am, and my regular listeners know I'm just blunt. We need a thinning of the herd. It 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 is just capitalism. And I remember going back, you mentioned, I don't follow a lot of the clips and stuff that you do. I actually try and stay off of mainstream media because it's depressing. But I do remember, and I want to say it was 2021, for the first time in history, there was more licensed real estate agents in the country than there was listed property in the country. And the at that time, the average realtor made less than $5,000 a year because the majority of them weren't doing anything. So there's nothing more frustrating than me as a real estate investor trying to call a realtor about a property and they don't return your call. Like actively right now, August of 2025, I've bought very little off the MLS in the last half a dozen years. Currently, I'm reaching out to more and more agents that, have properties that are sitting longer. And there was about 10 properties, I would say 3 weeks ago, that I still have not gotten a response from the listing agents of those properties. Shame on them for, taking a listing agreement for their client and not responding. But that's all of these part-timers. They're starving. There's I don't know if they're scared to call an investor or what the case is, and it doesn't really matter. The point is they're not. And so again, the thinning of the herd is going to happen. And yes, certain percentage of people are going to suffer. That's just the way it goes. And then there's a certain percentage of us that we're going to thrive because like you, I have been up and down. I was not in the greatest position to do anything about it in 2009, 10, 11, 12, versus today. So being able to capitalize on that up and down is what makes this fun, right?
Yeah, the real estate investors who have lived through cycles, we've created the most amount of upside and opportunity when there's a dislocation event, when there's a softening, when there's a moderation in values, when there's some level of pain out there in the street. Don't get me wrong, there's pain now. I mean, you've got office, right? That's easy to trash talk, obviously.
Yeah.
But we've even seen a lot of softening in multifamily fundamentals, expanding cap rates, declining rents. And to a degree, we've seen that in self-storage as well. And I think things were too good for too long. You had the perfect storm coming out of COVID of a historically low cost of capital from an interest rate perspective and perpetually rapidly rising rents. And you pour those two things on the fire, and that fire is going to burn hot and bright. And that's largely why we got ourselves into this inflationary environment. Interest rates should not have been that low. And believe me, we enjoyed that while it lasted, and we were lucky that we locked in a lot of debt during those years that was fixed rate, 10-year maturity runways. So we had some benefit from that. But those days are over, and it's a very different environment now. Now it's about operational excellence and execution and downside protection. And not to diminish a lot of the great returns that operators put up in those years, but if you had a pulse and you bought a deal in 20 or 21, and you made reasonable assumptions, even if you were terrible at executing, you were saved by compressing cap rates and rising rents. And that salvation is, for the time being, I think indefinitely and maybe in perpetuity, is gone.
I can give you a perfect example. I deal mostly in residential real estate, and I had a lead on a house yesterday. I called the guy. He bought the property in 2023. It was a hoarder house, and he paid $109,000 for this property. And it easily needs $100,000 renovation. And of course, this is in the Midwest, so wherever you're listening to this, put your numbers on it. But I started asking him typical questions. Number one, why didn't you do the project? And well, we've got most of it cleaned out. It's been 2 years. They're still cleaning it out. I said, great. What do you think it needs in renovation? I'm not sure. What do you think it'd be worth after it's renovated? We haven't figured that out yet. So this guy just went and bought a property. He overpaid for this property. He probably paid double what it should have been. and he has no clue. And it's free and clear. He has no debt. But that's the problem is when people are going and paying too much, they inflate the market for the rest of us. And that's going to be the same person that's crying in their cereal that, they lost their money or they got fill in the blank with whatever sob story they want to fill in, right? Lack of education and just go and do it. And I remember when I was getting my butt kicked in '06 and '07, I was buying and developing Florida real estate. And there was somebody said when the pizza delivery driver is putting up a spec home, it's probably time to get out. And I'll never forget that. 2 decades ago, I'll never forget that saying. And I don't follow the herd. I will not follow the herd.
Um, I think the lack of sophistication in the real estate investment space is not limited to price points. Just because you might think, oh, someone's doing $109,000 deal, maybe they don't know what they're doing. We've seen unlimited stupidity on $20 million deals, and maybe we're wrong, and we probably are. But we'll look at a deal that we can maybe pencil to pay 17 million for, and it trades for 20, and we just scratch our heads like, what are you putting into your model that is making you believe that this is going to have a positive outcome? And that just keeps happening. And I think that's going to moderate here as we get some clarity on where the economy's going. And I think a lot of this pent-up pain that we haven't realized yet, we haven't seen the broader numbers, is going to start to surface in a more obvious way. And time will tell.
And I love the people that are trying to sell their stuff based off of projections of what could happen, not based off of their actual financials. It if it could bring in that revenue, why are you not bringing in that revenue?
Yeah,
And
that's called selling the dream. And I'll tell you from a depth of experience, the dream sells for more than the reality.
yeah,
Yeah.
absolutely. Well, so you've obviously got a plethora of experience in a lot of different genres of real estate, but you really pride yourself on investor relations, right? Maybe touch on that a little bit, Jacob. I've raised a lot of money over the years, and a lot of my listeners have as well. But I also see a lot of investors losing money right now. They got into bad syndication deals. They're scared to death, and or they got into good deals that had incredible returns, and those aren't as readily available anymore. What do you specifically see with your investors?
Well, you've got this conundrum now. You've got an increase in the perception of risk and a decrease in targeted returns, right? And those two things make capital raising very difficult. And I think the theme, we have some large, ultra high net worth investors. We have some institutional joint venture partners, and we have our normal kind of retail investors. They're self-employed, they're high income professionals, and they want to diversify. But the consistent theme across all of them is a theme of reluctance. And one common question I'll ask when I either talk to a potential new investor or check in with an existing one is, how are your other deals going? And the stories I'm hearing are just astounding. Some deals are hanging in there and performing, but I'm hearing about a lot of equity wipes, meaning they put money in and they lost a big percentage or all of their equity. I'm hearing about unplanned capital calls. So an unplanned, I should say, a happy capital call is you sign your documents and you wire your money in, and let's go. We're partners. Let's go make some money together. An unhappy capital call is you've been in the deal for 2 years and the sponsor emails you and say, I know you put in 100 grand. You got to put in another 25K or you're going to lose all your money. And that's a really tough decision to make, right? And then we're also hearing a lot about ceased distribution. So distributions were happening reliably, distribution stopped. And that the common theme, I think, between all of these issues is typically it's a debt issue. It's a debt maturity problem. It's a floating rate debt covenant problem. They might have originated the loan in 22. It didn't mature for 5 years, but their interest rate is tripled. They can't refinance because of a debt coverage issue, and the deal needs money. So a lot of folks have been burned for sure. And well, what do you expect when fundamentals change, right? But I think capital raising is very difficult in this environment. But I've been raising money for a long time for my whole career, and accepting somebody else's capital into your deal is it's a sacred and terrifying responsibility.
Mhm.
And a lot of the times, we have investors from all over the country, and we have some that are overseas. You'll never meet these people outside of maybe a Zoom call, and they're signing documents and wiring you money. And that's a responsibility that we take very seriously. And whether a deal is performing or it's not performing well, I think transparency and truth and kind of what's happening in a given portfolio is really important. People want to know what's going on. Whether they read it or they don't, is kind of up to them. But I think delivering bad news faster than good news is really important in this environment.
Well, as you say that, I go back to a, a former business partner of mine, and it's been a year and a half. Yeah, we co-owned a hard money lending company together, and nothing but good things to say about him, other than he avoided conflict, right? So he would not deliver bad news faster than good news, and that was typically either fell on me or it didn't happen, and hence the reason we're part of the reason we're not partners anymore, right? There's To me, your investors are your lifeblood, and you do whatever you have to do, fall on the sword, you take the hits, and yes, they may still lose money, but if you handle them correctly, they could likely come back around or stay involved with you. But I really that was my lesson learned in '07, 8, and 9 when I was getting my butt handed to me. I didn't have investors. This was all institutional debt that I had. And I walked into my local community bank and I asked for a meeting with the bank president and my loan officer. And we sat in the boardroom and I talked about what was going on because my Florida real estate was tanking. My Wisconsin real estate was, cash flow positive and paying for itself. And that's what they were funded into. And I remember the bank president saying to me, nobody does this. Absolutely nobody comes into the bank and asks for a meeting to talk about the negatives. Again, a lesson I'll never forget almost 2 decades later. And you know what? 2 decades later, nobody does it to this day because they all
Yeah.
want to hide from it and blame somebody else.
Yeah, even though they're not technically, we view our bankers as our investors as well. I mean, they're the biggest percentage of our capital stack, and they need to know what's going on too.
Yeah, and the problem with bankers is the relationship is important, but they could leave. They could get fired, they could take a promotion at a different bank, and you're kind of starting over with the new person that's in their place. So you have to keep consistent relationships with them. And as that one person that you had a great relationship with is exiting, they should be singing your praises to their replacement if you did it right.
Doesn't always happen. There's a lot of
No.
rotation in the banking industry for sure. Yeah, you spend all that time building a relationship up, and then they bounce to somebody else. Happens a lot.
Yeah. Well, let's go backwards a little bit to the actual investments that you guys are working on or have worked on. How do you source your deals? Is it a combination of brokers and grassroots efforts, or what has worked the best traditionally?
Yeah, I'm going to use the term off market very carefully because off market means very different things to different people. I would say about three-quarters of our deals we've sourced in the last 2 years were off market. By off market, I mean nobody else has seen it. They've often come from a broker relationship who's got a line on the seller. They'll give us pricing guidance. We'll say if we can meet that or not, and then we proceed. And they come back to us because unless we find a major problem, we generally execute, when and how much we say we're going to. We don't retrade, unless we find a major issue, environmental or zoning or a survey issue.
Mhm.
The balance of our deals that were sourced, that were actually marketed, were typically kind of poorly marketed. Maybe somebody's got a storage facility and they've got a broker cousin who's a Remax agent and they put it up on the MLS, right? Yeah, it's marketed, but most people looking to buy storage are not going to be looking in that database to find a deal. If it's a widely marketed property through a national brokerage outfit, we bought a handful of those. But for the most part, we just cannot compete. Somebody else out there with a much lower cost of capital, lower return threshold, and frankly, a higher appetite for risk is generally going to pay more than we will.
Mhm.
But we continue to see a pretty wide bid-ask spread between what sellers expect and what buyers can pay. And I think that's resonant, that's real estate industry wide. It's not just self-storage, it's apartments, it's retail. Deals are still transacting, obviously, and there's a lot of transaction volume, but it's not nearly what it used to be. We have a team of full-time acquisitions associates. All they do is model deals, talk to brokers, submit LOIs. We've done a little bit of direct-to-seller marketing over the years, and we've gotten a few deals done that way, but it's a very, wide funnel at the top and very narrow at the bottom. So most of them have come from kind of pre-existing broker relationships.
Is there specific to the self-storage, is there a minimum number of units that you want to see before you're even interested in it?
We typically express our minimum deal size through the lens of dollars and not so much a unit count or square footage. Um, in the commercial real estate business, generally a deal that's relatively small is going to take the same amount of time and effort as a larger deal, right? You still have to get a bank loan, you still have to get your third party reports, you still have to put together the LLC and do your offering and raise your money. So generally, we're not looking at stuff that's under $3 million, which typically is about 30,000 square feet. Our sweet spot historically has been all in at 7 or 8 million, kind of in that range. Our biggest project we've ever done from an individual asset perspective is all in at about 25 million. And one of the unique things about self-storage among many is relative to the commercial real estate world, the deal sizes are relatively small, right? I mean, there's plenty of $200 million apartment communities out there in the country that transact frequently, but there's not a lot of individual storage facilities that reach price points north of 20 or 25 million. So to get to scale, you have to do a lot of deals, especially when you're averaging 7 or 8 on each deal. But yeah, generally minimum 3 million all in roughly, and kind of sweet spot is 7 or 8.
So how do you structure your investors in those types of deals? Are they coming in and they're getting some equity and some, depreciation, or are they just coming in and getting a preferred rate of return? Or and maybe you have different structures for different types of transactions too.
Yeah, I mean, our structures differ a little bit as far as like the splits and the waterfall go over the years, but the one common theme between all of our investor structuring is they are equity owners in the vehicle, whether it's a single asset deal or a fund portfolio. And that means they're participating in the tax benefits. They get a K1. We'll typically do a preferred return component. Not typically, we always do. Lately, that's been 9%. So a 9% accruing preferred return. And then splits over the years thereafter range anywhere between 80/20 to 70/30 in favor of investors, depending on the deal risk profile, the deal size. But all of them are equity owners in the deal. They've got membership units in the entity, and they get K1s. And their cash flows and the distributions the deal ships out follow that waterfall. So prefer return first, then return of capital, and then after those two things happen, it's a split that's in their favor.
So you don't have to tell us how many people you're trying to, keep track of, but I know that you kind of in kind of an industry leading investor relations guy, you've got a platform for it. What did that look like, or how did you build that out?
Well, I would say we're far from industry leading. We're a lot less stupid than we were, last year and the year before. So,
Well, I was trying to compliment you,
yeah,
Jacob.
well, I appreciate that. I
Yeah.
just want to set you straight. Yeah, I'll tell you, we have 427 investors and what we would call unique positions across our portfolio. So tax time is very difficult. We're putting together hundreds of K1s. We're trying to get those out by the end of March. Most of our LPs extend, but for the minority percentage who don't, it's really important for them to get those on time. We do quarterly reporting. We also have an internally built real-time investor reporting software that's essentially an API into our property management software. So investors can log in and they can see real-time performance metrics that are updated every couple hours with metrics like occupancy, net rental activity, revenue, delinquency rates, ancillary income streams, all kinds of stuff. But it continues to be an evolution,
Mhm.
right? It's hard to get reports out as frequently as we want to or on time. A lot of work goes into them. We have a lot of individual single asset deals that need their own reports. We have fund portfolios. So it's always a challenge. But again, at the crux of what we're trying to do is transparency. Just inform them what's going on, give them a copious amount of detail, but also for the people who don't care about the detail, give them an option to read 5 bullets. This happened, that happened, this is good, this is bad. And frankly, a lot of our investors, that's what they care about. Just a quick snapshot. Is it on track? Is it off track? If it's off track, why? What are you doing to fix it? Then they kind of move on with their day. But yeah, investor reporting, investor uh, distribution of K1s in a timely manner is a challenge for sure.
How
I don't
big
know if we'll ever be good enough at it.
how big of a team do you have running this whole operation?
Well, we self-manage our entire self-storage portfolio under our subsidiary, which is called Clear Home Self Storage. And the bulk of our team is in Clear Home. There are on-site managers, our regional managers, asset managers. So we have almost 90 employees throughout the platform, and I would say about 75 of those or so are our operations team, and the balance is here in our Denver office, controller, HR, accounting, our director of operations, acquisitions team. So it's a fair amount of people. But again, most of those folks on our team are operations.
So you have no stress, no overhead concerns.
Not at
Life
all.
is
Not at
life is
all.
grand, right?
Yeah, our overhead is astounding, and that's always the balancing act as an entrepreneur, whether you have a small asset base or kind of a medium-sized one like we do. It's balancing what you need from an expense load perspective against the recurring revenue that you're creating, and that's always a tough balancing act, right? And some of it is kind of predicated on deal volume. How many deals do you think you can buy in a given quarter or a given year? And lately, it's been very few. So that's always a tough line to walk, balancing that overhead with our incorrect predictions on future acquisition and disposition volume.
But is it built to where you have to continuously add more deals, or could you pull back, obviously get rid of some staff and just maintain the portfolio you have?
Yeah, people will sometimes ask like, what are your goals for whatever 26? And a lot of real estate shops will say, I want to get to some, assets under management target. I want to be $1 billion asset base from 500 million or whatever the case is. And it kind of sounds flippant and maybe makes us sound stupid, but we don't really have those goals. We're simply of the mindset that if we find a deal we love, we're going to buy it. And if we're not finding a deal that we love, we're not going to buy anything. Here we are 8 months into the year. We've bought one small acquisition so far. We've got two or three in the pipeline that might or might not hit. But you can make any deal pencil and make it make sense in the model. You just have to believe that you can execute to those assumptions. And in this environment, there's very few of those. But we can survive and sustain with just our recurring revenue streams from our current portfolio. And we want to buy and we will buy. But that's difficult these days for sure, for a lot of different reasons.
Well, and I think that goes across all asset classes too, right? Like never force a deal. And that's what most people get caught up in. And I've seen it many, many times. Again, lessons learned from '06, '07. I've passed up on a lot of deals over the last couple decades that I probably would have made a boatload of money. But, after going through what we went through, I'm a hell of a lot more timid. And now that said, when I see a good deal, I'm grabbing it. I'm going to snatch it up. I'm going to close, but I'm not going to get into a bidding war with a bunch of rookies that are willing to overpay and just to keep my contractors working or just whatever, right? Fill in a blank with whatever excuse you want to make. And we've seen, the last couple of years, the thinning of the herd with wholesalers, and they used to get these gigantic wholesale fees, and they were selling to rookies, and now they're starving. Well, they didn't really build a sustainable model. They did really great when they did really great, which was awesome, but most of them didn't bank that money. They just, they either blew it or they shoved it into more marketing or whatever it was, right? I had a buddy of mine in Dallas. I mean, he was averaging 25 to 40 wholesale deals a month. His overhead, just single family homes, his overhead was insane, just what he spent in marketing. And he was so damn stressed out. Like, what's the point? You know?
Yeah, we've been there. I mean, we mostly bought deals at the auctions here in the Denver Front Range, and the auctions dried up. And for a while in tandem, we were building our storage portfolio, but we kept our residential business going. And it was all direct to seller marketing. And you might buy a flip that will have a net profit of say 50K, but you spent $40,000 in marketing overhead that month to source that one deal.
Mhm.
Uh, and you talk about sustainability, and that's not a sustainable business, right? And you go to the next month, you don't buy any deals. Well, following month you got to find two just to break even. And it's a business I miss. We did a lot of fix and flips, and I know it well, and it was a lot of fun. But it was really transactional, and it was hard to scale. And entrepreneurs always talk about scale, right?
Mhm.
And scale, and I guess bigger is not always better, right? I've seen plenty of companies, and we've been guilty of this some quarters too, where oh, look how much bigger we got, yet we're not making more money, right? How did that happen? Well, I mean, you got bigger, but you added the same amount to your expense load. Um, so that's one of the reasons we like the self-storage industry is, we shifted to being a lot more long-term hold and kind of cash flow focused
Mhm.
versus buy, make better, and sell focused. And we will sell our deals eventually, and we've sold a number of them since we've been in the business for 10 years. But we don't love selling because when you sell, you pay a lot of taxes and you kill that durable recurring revenue stream that was paying you every month by quantifying it with a liquidity event, and then it's over. But you got to find somewhere to redeploy that capital. And in this environment, it's very tough from our investors' perspective. From our perspective, it's hard to find places that are obvious to park that cash right now. Buying to the stock market, well, that's at a record high. I don't know. Buying to real estate, I don't know. There's some cracks in the foundation. It's not easy for all of us right now to figure out where to put our money.
I had that conversation many, many times with people, especially when we were in the hard money lending space. You either have too much money available and not enough, deals, or too many deals and not enough money, and they never equal out. And that is a level
They
of
never
stress
will.
too.
Ours have never, we've never equalized
No.
ever. I mean, the last 2 years, it's been very little money and very few deals. It's kind of been both, but I can't tell you how many years and eras we've gone through where it's too much one, not enough of the other, and they'll never be in balance.
No, and that's the part where you just have to realize it and figure out where am I happy? Because we had the same problem in our lending company. We grew really fast in 2020 because all of a sudden all the national hard money lenders couldn't sell their paper on Wall Street. So our applications went through the roof and we could cherry pick the best loans, which was great. But we had to turn down a lot of really great loans because we couldn't fund them. And and we were doing 20 to 25 loans a month through 21 and 22 and into 23, but we also had way more overhead. We had way more, just stress of making sure that those loans were decent deals, but then they were actually following through with stuff. And when the interest rates started to go up, a lot of our borrowers, had bought these as rental rehabs that they were going to refinance. Well, all of a sudden they can't refinance or they won't cash flow, right? So it's always glamorous from the outside looking in, but the inside there's always stress.
It's a grind. I mean, right now we've probably got somebody breaking into one of our units. We
Hmm.
probably have a homeless guy who's sleeping in one of them. We've got someone that's probably cooking meth in a storage unit somewhere. We've got a U-Haul that's probably backing into one of our $25,000 gate systems we just installed. Whether it's fix and flips, multifamily storage, whatever, real estate's operationally intensive. There's not much passive about it. If you want a passive investment, go find a good operator and invest as an LP in their syndication or fund. I mean, that's passive. But if you want to grow your wealth with your boots on the ground doing deals, it's intensive, especially when times are difficult.
Yeah, for sure. Jacob, what's one question I should have asked you that I didn't?
Oh gosh. Well, I guess one question we'll get, sometimes, doing various podcasts over the years is advice. And I'm not one to dispense advice because I'm still learning and I get a lot to learn and I'll never learn enough. But I would say if you're considering getting into real estate, and you haven't taken action, you want to be a real estate investor of some kind, whether it's passive or active. The worst thing you can do is nothing. The worst thing you can do is just sit around and wait for the perfect deal, read a bunch of books, listen to podcasts, and just not take action. Everything has got an element of risk. And my advice is take a risk. Deploy your capital somewhere, buy a rental, buy a flip, invest with a sponsor that you get to know that you can kind of trust and understand their track record. Because wealth creation in real estate takes a lot of time. It doesn't happen quickly. If it happens quickly, it's kind of accidental and it's often luck and it's market timing. But the worst thing you can do in this real estate investing world is nothing. There's no perfect deal. There's no good time to buy. There's no bad time to buy. There are just deals that have good risk-adjusted returns and deals that lack good risk-adjusted returns, regardless of what's happening in the market. So take action and take a risk.
Very well said. And I'm going to ask you one more question, not to get political, and I'll give you my viewpoint first. Um, you said the last 6 to 8 months has been a lot of uncertainty. I feel like, regardless of what your political background is or belief system is, there's been half the country that was really excited and half the country that was scared shitless, but 100% of the country really doesn't know what's going to happen. That's my opinion. I don't know where your head is at with that.
Yeah, there's never, I mean, we've never had a lack of uncertainty on what the future holds, right? And I think the fits and starts with tariffs. I think the geopolitical risk that we have out there with Russia and Ukraine, with Israel. Um, I think there's just all of this has created just more human emotion and human reluctance to go out and take risk. And interest rates, right? That's a big one, I think. And if you would have asked me in middle of 24, I would have guaranteed you, again, wrong, that we would have seen a material moderation in interest rates by the middle of 2025, right? And here we are, and that hasn't happened yet. I think there's a lot of wait and see attitudes to kind of see how things shake out with tariffs, with inflation, with what the Fed's going to do. Um, and I'm certainly supportive of smaller government and less of a regulatory environment and the free market. And maybe this will be a positive outcome with all these new policies, and maybe it won't. It's just too early to tell. But regardless of what side of the political fence you're on, um, I think people are becoming increasingly cautious, waiting for some maybe sign of clarity that they may never find. Time will tell.
Well, and if somebody's listening to this show and it's, 2026, 27, 28, sometime in the future, we recorded this in August of 2025. So you can look back and say you heard it from Jacob and who knows, right? That is part of the excitement and the frustration of what we do.
The rear view mirror is always crystal clear, believe me.
Yep, for sure. Well, man, I really appreciate your insight and the wealth of knowledge you are and are willing to share with my audience, and just really appreciate you.
Derek had a blast. Thanks for having us on today. We'll talk soon.
You bet. So for everybody else, till the next show, go out there, get off your ass, do some deals. That's the Derek way of saying what Jacob said to you, and go out and live your vision and love your life. See ya.